All right, let's jump right in. Welcome to this explainer, where we're going to put the AAPE ETF under the microscope and really dissect the mechanics of 2x leveraged ETFs. We'll be breaking down exactly how these financial instruments work behind the scenes, with a huge focus on the absolute core of it all, the intricate process of daily rebalancing.
So let's kick things off with a quick question to challenge your assumptions right out of the gate. If Apple goes up 10% this year, will the 2x AAP ETF go up 20%? Well, the answer to that is a resounding no. And honestly, understanding exactly why that is absolutely crucial before you even think about interacting with these kinds of funds.
Here's our roadmap for today. We're going to cover what the AAP ETF actually is, the daily reset button, how rebalancing works, the math of compounding, the volatility decay trap, and finally, why this is a tactical trade, not a long-term hold. Okay, Section 1. What is the AAPEN ETF, and how does it magnify Apple's returns? Simply put, the Leveraged Shares APE product is an actively managed exchange-traded fund. Its whole stated objective is to give you 200%, or 2 times, the daily percentage change of Apple stock, minus fees and expenses, of course. So if Apple stock rises 1% on a given Tuesday, APE is specifically designed to rise 2% on that exact same Tuesday. What's really fascinating here is that APE offers this magnified exposure, but with institutional-grade collateral and defined risk. It trades right on the CBO exchange. But unlike traditional margin trading, where a sudden market swing could result in a broker calling you up and demanding more cash, APE actually has a defined risk structure. You literally cannot lose more than your initial investment. Plus, its synthetic exposure is safely backed by U.S. Treasury obligations. Moving right along to Section 2, the daily reset button, and why that word daily matters so much. Listen, this is where the magic and honestly the risk really happens. You can think of daily rebalancing as pressing a giant reset button at 4 p.m. Eastern Time every single afternoon. Every day starts entirely fresh at a 2x multiple, completely ignoring what happened the days prior. That leverage target, it applies only to single-day returns, not to your weeks, your months, or your years. Which brings us to Section 3, how rebalancing actually works, looking under the hood. So let's crack open the engine and see what happens when that 4 p.m. bell rings. The Themes ETF Trust Advisor takes very exact step-by-step mathematical actions to ensure the portfolio is perfectly re-leveraged for tomorrow. See, a 2-buy fund that gains value today will actually be mathematically underexposed for tomorrow, so they have to calculate that exact difference. Then they buy or sell total return swaps and customized option contracts to realign the whole shebang back to that precise 200% target. It is a constant daily recalibration. All right, Section 4, the math of compounding, and when the math diverges. The really crucial thing to grasp is what happens when you stack those daily resets on top of each other over time. Take a look at this data we adapted regarding a 3x leveraged product. Notice how a fund that is continuously rebalanced starts to mathematically diverge from a non-rebalanced one after just a couple of days of market movement. Day 1, they behave identically, but check out day 2 and day 3. Because the rebalanced fund applies its multiplier to a constantly changing baseline, a brand new baseline set every single day, the final numbers start to drift apart. As this visual clearly shows, a 3.9% total gain in the underlying index over 3 days results in only a 10.9% gain for the leveraged product. This proves for sure that over time, the math just does not equal a perfect multiplier. I mean, if it were perfect, 3.9% times 3 would be 11.7%, right? But because of that daily reset, the compounding actually pulls the real-world performance away from what you might expect. Let's look at Section 5, the volatility decay trap, and the cost of a choppy market. This divergence leads us to a fascinating concept, the volatility decay trap. When we contrast a trending market with a volatile one, we see that while compounding totally benefits you in a straight line, a choppy market acts kind of like trying to run up a down escalator. If prices bounce up and down repeatedly, it will actively erode your principal because of those daily resets. Why? Well, because you always need a larger percentage gain to recover from a percentage loss. If the market is just violently chopping sideways, the fund is essentially being forced to buy high and sell low at the end of every day just to maintain its leverage ratio. And we have to talk about the extreme but mathematically inevitable downside to this. If Apple stock were to fall by 50% in a single trading day, well, an investor in this 2x fund would lose their entire principal investment. It's just math. 50% times 2 is 100%. The leverage gives you incredible thrust, but it also carries some incredibly dramatic downside potential.
Now for Section 6, Tactical Trade, not long-term. Who is APP actually for? Building on all these mechanics, let's talk practical application. This quote pulled straight from the prospectus really hammers home our central rule. AAP is a daily tactical vehicle. It is not a long-term buy-and-hold tracker. They explicitly state it's not appropriate for investors who aren't planning to actively monitor and manage their portfolios, frequently, if not every single day.
So instead of just buying and holding, sophisticated traders use this product for highly specific, short-term strategies. We're talking playing earnings announcements or maybe reacting to technical indicators within a single day. Actually, think of it this way. If a trader has high conviction that a piece of news is going to drive Apple's stock up today, AEP lets them express that exact conviction with magnified intensity, all without tying up excess capital in a margin account. And hey, if you are executing those short-term tactical trades, costs definitely matter. AKEP offers a highly competitive total expense ratio of 0.75%. To put that into perspective, that sits about 40% lower than the category average for comparable leveraged single-stock ETFs. So that lower fee really helps minimize the drag on returns for active traders who are constantly moving in and out of positions. So as we wrap up this explainer, I want to leave you with a final thought to help you evaluate your own tactical approach. Knowing the mechanics of the daily reset and how compounding and volatility decay actively shape your outcomes, does your current market strategy rely on holding a long-term trend or trading a precise moment? Because tools like APE are absolutely incredible game changers for trading a moment. But as we've seen today, the math makes them quite dangerous for simply holding a trend. Thanks for joining me on this deep dive.